There's a story about a man who built a spreadsheet so detailed it could predict almost anything: expected returns, optimal allocations, perfect scenarios. On paper, his plan was flawless, rational in every sense of the word. Then the market fell. Not a little, a lot. And in that moment, none of the equations mattered. He panicked, sold at the bottom, locked in losses. Later, he admitted something uncomfortable. The plan had been rational. His behavior wasn't. Here's what's interesting about that story. The failure wasn't a lack of intelligence. It was a lack of realism about being human. That's the tension at the heart of how we think about money. We assume the best strategy is the most rational one, the one with the highest expected return, the cleanest math, the sharpest logic. But money isn't lived on spreadsheets. It's lived in real time, with fear, temptation, uncertainty, and emotion layered on top, which leads to a counterintuitive idea. Being reasonable often beats being rational, not because logic is wrong, but because logic that ignores human behavior eventually breaks. Think about how often we admire financial strategies that look brilliant but feel unbearable. Extreme frugality, aggressive leverage, perfect market timing. On paper, they can work. In real life, they often don't. Nobody's crazy for struggling with this. Humans aren't machines. We don't experience money as numbers. We experience it as stress, hope, pride, regret, and relief. And that's where the first big idea begins. A reasonable plan is one you can stick with. A rational plan is one that assumes you'll behave perfectly. Here's the paradox. The best financial strategy is rarely the one that looks best in theory. It's the one that survives reality. I know someone who chose a conservative investment approach even though they knew it wasn't optimal on paper. Lower expected returns, more cash than necessary, less sophistication. When asked why, they said something simple: "I sleep better this way." From a strictly rational standpoint, that answer sounds weak. From a behavioral standpoint, it's incredibly strong. Because sleeping well means staying invested. Staying invested means compounding. And compounding doesn't care how clever your spreadsheet was. It cares how long you stayed in the game. Historically, this pattern shows up again and again. In the 1920s, highly leveraged investors made fortunes quickly. They were rational based on the data they had. When conditions changed, the same rational strategies destroyed them. The people who survived weren't the smartest. They were the ones with margin, with patience, with plans they could emotionally tolerate. Same psychology today, different wrapper. This brings us to the second idea. Rational decisions optimize for outcomes. Reasonable decisions optimize for behavior. That distinction matters more than it sounds. Rational thinking asks, what's the best possible result? Reasonable thinking asks, what will I actually do when things get uncomfortable? Here's the paradox. A strategy that is slightly worse but emotionally sustainable often beats a perfect strategy you abandon at the worst time. Modern examples are everywhere. People chase complex investment strategies because they promise higher returns. Then they bail during downturns. Others stick to boring, simple plans and outperform over decades. Not because they're smarter, because they're more honest about themselves. The invisible part here is humility. Being reasonable requires admitting you're not immune to fear or greed. That's uncomfortable, but it's also realistic. Evolutionary psychology helps explain why rational plans fail under stress. Our brains evolved to prioritize survival, not optimization. When we sense danger, logic narrows. Fight or flight takes over. Long-term planning disappears. So when markets fall or income drops, even the most rational person can behave irrationally. Reasonable planning accounts for that in advance. It builds buffers. It accepts lower peaks to avoid catastrophic valleys. I struggle with this too. The desire to optimize is seductive. It feels smart. It feels disciplined. But over time, you realize that the biggest risk isn't leaving returns on the table. It's abandoning your plan altogether. Which leads to the third idea. Reasonable people leave room for error. Rational people often don't. Rational models assume precision, that inputs are accurate, that probabilities behave, that you'll respond calmly. Real life is messier. Here's the paradox. The more tightly optimized your plan is, the more fragile it becomes. Think about someone who invests with no margin for mistakes, fully invested, fully leveraged, fully confident. When something unexpected happens, there's nowhere to move, no flexibility, no patience. Contrast that with someone who keeps cash, accepts lower returns, and moves slower. From the outside, it can look inefficient. From the inside, it feels resilient. Historically, the people who endure long-term success are not those who avoid mistakes. They're the ones whose mistakes don't ruin them. Reasonableness builds in forgiveness, for markets, for circumstances, for yourself. Nobody talks about this, but many financial failures aren't caused by bad ideas. They're caused by ideas that left no room for being human. This is why being reasonable isn't about settling. It's about sustainability. You don't need the best plan. You need a good plan you can follow when your emotions are loud and your confidence is low. Once you see this, a lot of financial advice starts to sound different. Less about optimization, more about endurance. Less about brilliance, more about consistency. And that reframing is powerful. We've talked about reasonableness as stickiness, as behavioral realism, as margin for error. But there's a deeper psychological reason it works so well. One that explains why smart, rational people still make poor money decisions. That reason has to do with identity, ego, and our need to feel smart. That's where the story gets even more interesting. There's a story about an investor who prided themselves on being disciplined. They read constantly, followed the data, trusted logic above all else. When markets were calm, that identity felt earned. When markets turned volatile, it became a liability. They didn't just lose money, they lost confidence. Because the thing they had built their self-image around, being rational, cracked under pressure. Here's what's interesting about that. When money becomes a test of intelligence, every setback feels personal. This leads to the fourth idea. Rationality often ties money to ego. Reasonableness keeps them separate. Rational strategies tend to reward cleverness. They appeal to our desire to feel smart, to prove we see something others don't. There's nothing wrong with that. Curiosity and analysis matter. But when your financial plan becomes part of your identity, changing it feels like admitting failure. And admitting failure is emotionally expensive. Here's the paradox. The smarter your plan makes you feel, the harder it can be to abandon, even when you should. Nobody's crazy for this. Humans protect their identities fiercely. Once we've told ourselves, I'm the kind of person who understands this, backing away feels like losing status with ourselves. History is full of examples. Brilliant economists and investors who stuck with failing ideas too long because those ideas had become extensions of who they were. They weren't wrong because they lacked data. They were wrong because they were attached. Reasonable people detach earlier, not because they're less confident, but because they're less invested in being right. The invisible part here is adaptability. And adaptability is a form of intelligence that doesn't show up in spreadsheets. This brings us to the fifth idea. Reasonableness accepts uncertainty. Rationality often tries to eliminate it. Rational models aim to reduce uncertainty through probabilities and assumptions. That's useful. But life doesn't care about your confidence intervals. Here's the paradox. The more you try to control uncertainty, the more fragile your plan becomes. Think about people who over-optimize portfolios based on historical data. They squeeze out inefficiencies, minimize volatility, maximize expected returns. It looks impressive, until something happens that hasn't happened before. And something always does. Reasonable thinking starts from a different place. It assumes the future will surprise you. It plans for unknowns rather than trying to predict them away. That mindset shows up in simple behaviors. Keeping cash even when it feels inefficient. Diversifying beyond what math suggests is necessary. Avoiding leverage even when returns look certain. From the outside, this can look overly cautious. From the inside, it feels calm. Evolutionary psychology again helps explain why this works. Our brains are uncomfortable with uncertainty. We crave narratives that make the world feel predictable. Rational models provide that comfort. Reasonable behavior provides protection. Modern examples are easy to spot. People who build lives that depend on everything going right. Perfect health, perfect income, perfect markets. And people who leave slack, who accept some inefficiency in exchange for resilience, same intelligence, different priorities. Here's another paradox. The goal isn't to be right often, it's to be wrong survivably. That's a reasonable goal, and it's a powerful one. I've seen people abandon good strategies because they couldn't tolerate short-term discomfort, and I've seen people stick with imperfect ones because they could. The difference wasn't math, it was self-awareness. Which brings us to a deeper insight. Reasonableness is rooted in knowing yourself. Rationality often assumes you already do. Most people overestimate their tolerance for risk, volatility, and uncertainty until they experience it. Reasonable planning takes that bias seriously. It asks, how will I feel if this goes wrong? Not just what happens if it goes right. Nobody talks about this, but many financial plans fail not at the point of maximum loss, but at the point of maximum emotion, fear, regret, envy. These don't show up in models, but they show up in life. Reasonableness designs around them. We talked about ego, uncertainty, and adaptability. But there's another reason being reasonable beats being rational. It has to do with time. Because money decisions aren't one-time events. They're repeated choices made over decades. And what works once doesn't always work repeatedly. That's where we'll go next. There's a story about someone who made a single brilliant financial decision early in their career. It wasn't luck alone. They studied the situation, took a calculated risk. The timing was right, the world cooperated. The decision worked perfectly. The payoff was large enough to feel defining. That one win became a story they told themselves about who they were. Someone with good instincts. Someone who could see opportunities others missed. Someone who understood how money really worked. Years later, they tried to repeat it, and then again, and then again. But something had changed. The conditions were different. The market was more crowded. Their confidence was higher, but the margin for error was smaller. Some decisions worked, some didn't. Eventually, one bad decision erased years of progress. What confused them most wasn't the loss, it was the pattern. Here's what's interesting about that story. The first win made perfect sense in isolation. The long-term failure made perfect sense in sequence. Money doesn't reward isolated brilliance nearly as much as it rewards repeated survival. This brings us to the sixth idea. Reasonable strategies work repeatedly. Rational strategies often work once. Rational thinking is very good at optimizing a single decision. It asks the right questions. It weighs probabilities. It looks for efficiency. It tries to squeeze the maximum result out of a given moment. That's impressive and useful. But money isn't a single decision. It's not one swing. It's not one trade. It's not one perfect call. Money is a chain of choices made over decades, under changing conditions, with incomplete information, while your emotions evolve, while your life changes, while your priorities shift. Here's the paradox. A strategy that maximizes returns in one moment can minimize them over a lifetime. This is why endurance matters more than brilliance. Think about compounding. Everyone talks about the math. Fewer people talk about the behavior. Compounding doesn't reward intensity. It rewards consistency. You don't need to make the smartest move every year. You don't need to be right often. You need to avoid the decisions that take you out of the game. That's a very different goal. Historically, long-term winners aren't the ones with the highest peaks. They're the ones who avoided fatal valleys. The ones who stayed invested when it was uncomfortable. The ones who didn't overextend when confidence was high. The ones who remained solvent when others were forced to quit. That's reasonableness in action. The invisible part here is time itself. Time doesn't just compound money, it compounds behavior. Small mistakes repeated don't stay small. They grow teeth, they stack. They turn manageable problems into permanent damage. At the same time, small good habits repeated don't stay modest. They snowball. They create buffers. They widen margins. They turn ordinary decisions into extraordinary outcomes. Rational plans often underestimate this because they focus on expected outcomes rather than lived sequences. Expected returns look clean. Life rarely is. Which leads to the seventh and final idea. Being reasonable is a long-term advantage because it aligns with how people actually live. Money isn't lived in spreadsheets. It's lived through marriages, through careers that stall or explode, through health scares, through children, through parents aging, through bad timing, through good timing. Through luck, you didn't earn, and risk you didn't anticipate. None of these are controllable. All of them affect decisions. Rational strategies often assume a stable world and stable behavior. Reasonable strategies assume disruption and emotional inconsistency. Here's the paradox. Flexibility beats precision in an uncertain world. A precise plan works only if the world cooperates. A flexible plan works even when it doesn't. This is why reasonable strategies bend while rational strategies break. Let's come full circle. The man with the perfect spreadsheet didn't fail because he lacked knowledge. He failed because his plan required him to behave like someone he wasn't under stress. Calm, detached, unemotional, perfectly disciplined. That's not a moral failing. That's being human. Once you see that, the goal of financial wisdom changes. It's no longer about finding the smartest strategy in theory. It's about finding a strategy that fits your temperament in practice. It's not about being right. It's about staying in the game. Knowing this doesn't make you immune to mistakes. You'll still make them. Everyone does. But reasonable thinking ensures mistakes don't compound into disasters. It builds forgiveness into the system. Forgiveness for bad timing. Forgiveness for fear. Forgiveness for being human. And that's the real skill. Because the most dangerous financial advice isn't bad math. It's good math applied to unrealistic behavior. Being reasonable isn't settling. It's choosing durability over perfection. And in the long run, durability wins.